Welcome to another inspiring edition of the Brandi Jo Show, your weekly dose of wealth and wisdom for a prosperous financial life. And here's your host, Brandi Jo Newman.
Well, Flint, thanks for joining me.
Yeah. So do you do syndications as well?
No, I find everything about that fascinating, but I'm a 50,000 foot level girl.
Okay.
I don't get into the details of that. I could probably screw something up really well and never be able to do that again. I have trouble with FINRA, so I also run a PAC, and it's a state PAC. It's not a federal PAC, so thank God. I only have to deal with the Texas Ethics Commission, and it's not that it's not that I'm trying to do anything shady or anything. It's just, you have to check a few boxes and make sure that your numbers and your commas and your decimals are all in the right spots. And
Yeah.
I'm not real good at those kinds of details. If I have to do that, I get people to do that for me.
Right.
So no, I am a full-blown financial planner. The old man, white shoes, white belts kind of financial planning, but it seems to still work in any economy and any financial environment. So,
Yeah.
I do tend to think outside the box when it comes to different types of investments. I hate calling them alternative investments because it's not. It is an alternative, but it's something that everyone should be doing. Because
Right.
as soon as pensions basically just went away and the transfer of someone's livelihood was transferred back to them to guarantee from pensions to 401ks, this should have been talked about years ago. It should have been talked about 35 years ago. So that's why I like to talk to people like you that have different opportunities for people to research and get educated and see if they want to invest.
Yeah.
I'm a partner.
So it's funny you mentioned pensions. I have a super small pension from Boeing when I worked there.
I have two. I have one from Guardian and one from One America. And they
Yeah.
do not offer those anymore. And then I have a friend who worked at Ernst & Young for years. She went all the way to partner. She has a pension with Ernst & Young, and they stopped them in 2005. So at the height of the market, they stopped the pensions.
Yeah. They stopped the pension at Boeing. I mean, I got in just in time, but it's only $38,000. And I was looking if I can pull it it's age 65, it'll be worth like 110. Like that is the worst rate of return. I'm just gonna pull it, pay the penalty, and then put it in some asset class that I get 15-20% on, because it's stupid not to.
Well, but if I may, you do have to have those guarantees on the opposite side of your balance sheet. You can't be in all risk all the time.
No, absolutely not.
So
But
it does pay to have some sort of guarantee, but because it's not, in my opinion, in my philosophy, it's not about the rate, it's about the flow, and you never know what's going to happen in the market. So I like to have both buckets full, the at-risk bucket and the guaranteed bucket.
yeah, is a pension really guaranteed?
Well, no.
Can Boeing
No.
decide that?
Yes.
Right.
So there are other guarantees out there on the guaranteed side. Mentioned that, I didn't say that your pension is guaranteed.
Yeah. Okay. Tangible assets, though, they're pretty strong.
Right.
As long as you get the debt right,
Exactly.
which.
So let's talk about a little bit about your background.
Yeah.
So, because I don't think anyone in this day and age, they can wake up and they can say, okay, I want to be a syndicator, I want to be a fund manager, I want to, have my own real estate investment trust, all of that kind of stuff. So tell me a little bit about your background and how you got to this position.
Yeah. So I'm classically an engineer with an MBA. I worked in aerospace my entire career, 20 years. But in 2018, I got into buying residential. So I bought a duplex, and it was a distressed property. So I turned that around. I renovated it and held it for 3 years and sold it 3 or 4 years. But I realized after buying a residential, not only was I was running solo, right? It was basically like I bought myself another job. The returns were meager. With the amount of effort and capital I put in, I was getting $300 a door, which was actually above average from what I'm told. So $600 a month, which is cool. But if I wanted to get to that point where I could exit my day job and live off of passive income from real estate, I would need to do that 50 more times. So that's when I pivoted to syndications. Now I'm not doing it all on my own.
Yeah. So the more doors, the better. Obviously, that's just scaling. On Friday, I had an interview with a guy, and we talked about Blackstone and BlackRock. And obviously, I mean, we all want to aspire to be that, but we don't want to be, kind of we don't want to be the evil, sinister investor in the world. Tell me about some of your deals that you have going right now, and tell me about your best deal.
So I really hit the ground running at the beginning of last year. So I'm now, I don't know, 4 or 5 deals, maybe 4 deals in. On the active side, I have a bunch as an LP as well. I'm a passive investor in other deals. So for the most part, the properties are still running positive, right? The interest rates went up. They hurt cash flows, but we're still in the black, I guess, from an accounting perspective. The properties are still running positive, and the valuation is still going up because we're still renovating units. We had to slow down on our renovations to improve cash flow, because before, when the interest rates were lower, we could vacate a lot more property or a lot more units and renovate more at the same time. So the interest rates has forced us to slow down on the renovations, which slowed our growth. But with that said, we're still renovating units. We're still improving the valuation of the property with higher rents.
Now, debt, adjustable, is it fixed?
It's all of the above, depending on these properties. One in particular, it is adjustable, but we had a cap on it, and we've hit that cap a long time ago. The reason we had to do that is because we couldn't get a fixed loan, and we wanted a loan to cost as well. So we didn't have to raise all the CapEx renovations. So there's reasons you have to get into those bridge debt, and they are adjustable. But if you can protect yourself with a cap, on that particular property, it did cost us a fair amount to get that cap, but thankfully we did. Oh, I'm losing you. I can't hear you. You're slightly coming through.
Is it all pixelated?
There you are. Now you're back.
Okay. Where is that property located?
That one's in Augusta, Georgia.
Okay.
And so the first deal, that was the beginning of 2022. By April of 23, I put together a fund of fund, which was a portfolio of 3 properties. It was actually a Class A asset, and then 2 Class B Cs. And those are value adds. And so those had unique debt. One of them had a mezz loan, other has bridge debt. So yeah, it's kind of all over the map. But as long as we were getting into that portfolio property, the stock market had started taking a hit last year. I think it was around April. That's when and so we knew something was happening, and we were reading the tea leaves and knew that we had to immediately get as low caps as possible to protect ourselves on those properties. So we went in basically capped out, and we were like 5.5% on those loans.
So explain, because I have an audience that is very mixed and diverse. I'll say that. So
Yeah.
explain when you keep saying cap, explain what that is.
Yeah. So what we do is on adjustable rate loans, we essentially, it's like paying for insurance on debt. So you pay like $1 million to put a cap. So maybe we got in at 4.2%, but it's adjustable, and we put a cap at 5.5%, and it cost us $1 million. So when we hit that mark, we don't have to pay anymore. It's actually coming from the cap provider, which is, you can essentially call it like insurance. Insurance is covering us, even though it's not insurance.
Okay. So the $1 million is also financed. Is that right?
No, that was just, no, we had to raise for that, I believe. Now that's a minor detail. I wasn't in the heart of getting the lending on that. So
Okay.
Back to the syndications for your audience. There's a big team of us, and we all have our expertise. I'm smart enough to get in trouble in certain areas, especially in lending, but I am not the focal who goes and gets those loans. And there's a lot of details even behind the scenes, and that rabbit hole goes pretty deep.
Yeah. So how many of you are there?
Depends on the property. So let's say the Augusta property, I'm going to guess there was 15-ish of us. The fund, that one, there's no way for me to know that number, because we have 3 properties, 3 different operators, and each one of those operators is their own business of themselves. So they have basically a company. The primary fund, there's probably 50 people involved in that.
Okay.
And then, yeah, right now I'm doing built to rent. There's we're doing a development project that's got a lot of people. And then I also we're going to close on a townhome deal in Columbus at the end of this month. And that's probably another 15 to 20.
Okay. On the Augusta property, what's that valued at?
Oh, we bought it at 14 million.
Okay. How many doors?
104.
Okay. Any masters people come in there and rent, and you can blow it out?
Yes. So that is such a great question. On that property, there's 4 buildings, and one of the buildings is small. There's 8 units in that one building, and we're starting to convert that into short-term rentals. So I think we now have 2 online. We had 1 online during the Masters, and it did fairly well. I actually don't have the numbers, but there is
what you charge for that.
Actually, I should have looked, but I didn't. I know that the numbers are really high for that. So that unit did really well during the Masters. But based on our numbers, when we did the underwriting, we partnered with a super host. There's this guy who lives in New York who has like 100 units in Augusta. He is the super host of Augusta.
Wow.
And we reached out because we're like, we don't want to operate a short-term rental. We want to provide the unit. So we'll do a profit share with you.
Yeah.
And so he came in and he furnished it. He's got all the systems in place, right? It's all about systems and scale and economy. Right. So we bring him in. He bought all the furniture because that's what you got to keep furniture common across all the units. So we're about ready to bring the second one online if it's not online already. And we may continue to expand as long as there's demand.
Yeah. Well, just getting to Augusta during Masters Week, you don't really need to get tickets to the Masters. You can get practice round tickets pretty easily. But the amount of people that just show up to be there during Masters Week is incredible.
Yeah.
So how many deals do you have going right now that are open and ready for?
Yeah, that we're raising capital for. So there's the Columbus deal, and then we have 3 development projects going, build to rent projects. Okay. And for your listeners, build to rent is another way to call it as horizontal multifamily. So we essentially build a community of single family homes, but we operate it like an apartment building. So it's a commercial property. All the residents have their own front yard, backyard, their own four walls. It's like a little starter home. We have the amenities and clubhouse and all that. Super hot asset class right now. We were talking Blackstone, BlackRock. They are just throwing money at build to rent communities because there's so much demand for them, but they don't build. So they will buy from us. So we're gonna go develop, and we actually have 3 of those properties in development.
Where is that, the one in Columbus, or is it elsewhere?
No, those are there's one in Foley, Alabama, and 2 in Lafayette, Louisiana.
Lafayette. I have cousins there. That's the other side of the family.
Nice.
So what's a minimum to invest with you? Like what are
typically it's $50,000.
Okay. Do you need to be accredited?
Not necessarily. It depends on the deal. So we do have
it depends on the deal, and it also depends on how the person comes to you, is what I've run into.
What do you mean by that?
Connection, and because you can't market to a certain, blah,
okay,
blah, blah,
yeah. So
and blah, all of that.
All right, you opened up the door.
Yeah.
Here we go.
Again, the details that I do not get into.
So if you're an accredited investor, which means you have $1 million net worth, or you make $200,000 a year for the past 2 years, or 300 as a couple. If you meet that threshold, you can get into any one of these syndication deals because you're accredited and the SEC views you as smart enough and has enough money, and you can throw money at things at your will. If you're not accredited, then you have to have a substantive relationship with the deal provider, which would be me. I have to form some level of relationship with my investors. I like to do that anyway, even with accredited investors.
That makes
sense. I don't want to offer something to someone if their financial goals don't align with what I provide.
Right.
But with that,
so you do a qualification.
Yep. Okay. I do a qualification. And I call it kind of like there's a seasoning period as well. We just kind of establish you have to be within my network for 30 days. You have to have at least spoken with me once. But for what we call the 506B deals, this is an SEC exemption. For sophisticated investors, you're right, we cannot advertise. You have to be in our network for me to send you a deal. So for a lot of people out there, you do not ever see a whole lot of deals because a lot of them are done in this 506B category where you have to be within someone's network and establish a relationship with someone. With the 506C, Charlie, we can advertise however we want, throw up billboards, put it on Facebook. And those are for accredited investors only.
Now on the build to rent, how many doors is that? And are you building like from the ground up? Are you buying the land?
Yes.
Doing the
phase
one, all of the finish out?
Yeah. Good. Phase 1, 2, and 3. Okay, so phase 1, we do buy the land. And that part of the phase 1 is getting it entitled, zoned, environmentals, engineering, that whole bit. Phase 2 is what we call infrastructure, or the horizontal phase, where we cut dirt, roads, utilities, and sidewalks. And then phase 3 is when we go vertical, building, whether it be a house or an apartment building. Yes.
How do you choose the location?
Yeah, it's all about location when it comes to development. In this particular scenario, we partnered with a housing builder. I mean, that's the best way to do it. This guy's been building homes for 30 years. So we become the financial branch to this build to rent. One, you want to have a city government that's going to be a proponent of you building, because there's this NIMBY culture, not in my backyard, where you can take this, buy a piece of land, and you're going to say, I want to build 150 homes. And all the locals in that area will go in and vote and say, no, you can't do it. You can't do it. We don't want more people. They could shut you down. And this is why development is considered risky, is because you could get shut down there, or they could take a year and a half to get you zoned and then approvals, and it could be super painful. So I think the biggest thing is a location where you can get approvals done quickly. You know that you will not get voted down by the locals, and you can get the project approved. Once you're past that whole phase one, entitlements, environmentals, and getting the engineering approved by the city, then you're good to go. Now you're in development. And then from there, your risks are cost of building materials, that we've seen those kind of fluctuate a lot. Luckily, they're coming back down from COVID. And then labor is also a challenge these days.
So two things. The partnership with the builder, is that a split, or is part of your capital raise going, is he supplying capital to build?
Yeah, well, so this could be split in many different ways depending on the groups. I think the only way to make a build to rent in a syndication successful is if the builder is part of the general partnership. He's part of us. He owns equity, so he has stake in it. And in our particular scenario, between the general partnership and the builder, they bought the land and they're paying for all the entitlements. They're essentially paying for the riskiest part of the project. We're bringing capital in from retail investors at phase two, at phase two, the infrastructure. So it's past the riskiest part.
So that builder already had the land. So is he contributing the land to the deal? And so then the land.
Yeah, he's a part owner of the land. And then another one of the primary partners on the syndication side is the other primary owner. So they own a large share of the equity on that land. And now and just like putting a kitchen in your home, it's forced appreciation, or flipping a house. Land, if you buy a raw piece of land that's not entitled or anything, doesn't have any paperwork to it, it's relatively cheap. As soon as you get all the entitlements approved, the engineering approved, zoning, now that land is worth more. Sometimes you hear people called land flippers. That's exactly what they do. Right. They don't touch the dirt, but they give you a whole bunch of paperwork, and that costs a lot of money. Yeah. So at every step of the way, that property becomes more and more valuable. Right. So they're riding the equity train or appreciation train with that property, and it's fruitful.
Do you look at certain populations? Do you look at certain areas of the country? Like, how are you picking Lafayette, for example?
Yeah, so we look for places going beyond just finding a city that's willing to approve things smoothly for us. You have to look at the economics. Is there plenty of jobs? Is it a growing market? Is there a demand for our residents migrating there? Right? You got to look at all of the human factors and where you're going to get residents from. If it's a stagnant market and people are migrating out of there, we definitely don't want it. The other thing is we don't want rent control. We want landlord-friendly states, because like California has rent control, and it becomes really onerous to manage a property, to raise rents. Like you could just, at some point, expenses can grow beyond what you can collect rents for. Mm-hmm. And then you're just losing money, and property owners just can't even own a property that you can't make money on. Right. So we go for landlord friendly states.
And I think I am watching at one of the golf courses here in town. This particular area has had some issues getting the engineering correct. Basically, homes sliding off of hills. So now they have finally found the right engineering and the right schematics to make these homes stay on these hills with these incredible retaining walls that they've built. And there is there are 3 apartment buildings that have gone up, and now it seems like they're building in the back 2 levels of single family residences. And I was playing golf and I'm looking up and I'm like, that's a build to rent community with a clubhouse and apartments.
Is it already built, or is it in the process of being built?
Getting built. So it
Is
looks like they've framed, they've done the stucco, they've done the roof.
Okay. Because I know someone that's doing built to rent community right now. It's still in the horizontal phase.
In San
They're-
Antonio?
Yeah,
Okay.
it's supposed to be at the highest point in San Antonio.
This is, yes.
It's right there.
Then-
It's
then
like there's
that
a park that's the top of the hill, and they're kind of building next to that park,
park at the top of
or they're going to put in a park. There's a historic site.
Okay, well, this is one of the highest places.
Okay.
It's in northwest San Antonio. I mean, have you finished a build to rent development?
I personally haven't. No,
Okay,
no.
like what is because renters, judgy, whatever. Do you find that the value stays? Do you find that because, and I'll just put it out there. We have,
Yeah.
we have a developer, well, it's KB Home. And, if you know the politics of who runs that, they build these neighborhoods and then, it's a family that moves in and there's 16 cars and there's crap everywhere. And real estate investors come in, they buy the home, and then they immediately rent it out. And it just seems like those neighborhoods don't hold their value as
Yeah.
well.
If that is allowed, then they would not hold their value.
Okay. Is there an
we've-
is there an HOA? Is there a ROA?
Well, so this is the thing. It's managed like an apartment building. You have on-site maintenance and property management. It's like having an HOA, right? That you're gonna control the tenants that are getting in there.
Okay.
And these are,
Because it's a controlled
yeah,
area.
it's
I mean,
very
it's-
controlled.
I got you.
And we are building higher end homes. Jarrah Horton's in Foley as well, doing build to rent. And they kind of went in there and did just the basics of basics, and it was just a low quality build. And we're gonna do more like hard surfaces, stainless steel. We're trying to attract tenants with a higher income, the people that want to have a nice brand new feeling home.
Mhm. And what are your terms? Years or a year?
Or a lease.
Yeah.
Yeah, it's typically a year, but that doesn't mean that residents in build to rent, what was the stat? On average, they stay 3 years versus an apartment, which is like 18 months.
Yeah.
Because people they treat it like their home. It's like a maintenance-free home because they don't have to take care of the lawn
I love
maintenance.
that.
So we're actually getting the two different types of primary demographics. You get the millennials who are trying to start a family, who need to get out of an apartment, who can't afford a house. So we are the best compromise in a built to rent. They get a home. And then you have the empty nesters who are tired of taking care of the maintenance on their old home, and they want to move maybe closer to the grandkids. They'll move into a built to rent community, no longer have to deal with maintenance. The walk and leave culture, you can just leave and go on vacation. Doesn't matter because you have property management there that can watch it for
That's
you.
me. I'm the walk and leave. I want to go someplace for 3 months where it's not 110 degrees and
Yeah.
110% humidity. Where are you right now?
I'm in Denver.
Okay. Beautiful. So let's talk about the Lafayette development. The Lafayette was keen. They were open. Was there any pushback when you went and talked to the city?
I mean, I wouldn't call it pushback. There's always iterations. And let me give you the best example. And this one's actually the Foley, Alabama one.
Okay.
We engineered and plotted the whole land, figured out we're going to put in 155 units or 158. And then the city came back and they're like, oh, you know what? We really want a turn lane. And the width of the turn lane is basically takes up the land mass of an entire house. So we had to go back and reshuffle the deck essentially of plotting how we're going to lay out the homes and move some things around. So there's always little things here and there that you end up dealing with just because you're dealing with an efficient municipality. But I would say it's still smoother than municipalities that could take a year to even get around to looking at your documents. With our stuff, they're actually motivated and they really want to try to help, and they really want the community there because they need housing badly, and we're providing a really great product for the residents. So they're trying to work with us. Unfortunately, there's still, like I said, there's always some level of swirl.
Yeah. So what's the population of the Alabama property where it's located?
Oh, I should know this number off the top of my head, but I don't. I'm sorry.
And what is it? What's the name of it?
Foley,
Foley.
Alabama.
Foley.
Foley. So it's 9 miles from the Gulf Coast. It's about 45 minutes from Pensacola, Florida.
Nice. Foley.
Yeah. Foley.
Yeah, you got to be
It's
able to use the twang.
Yeah, that county is the fastest growing county in Alabama for the last 10 years straight. So it is booming.
So that's significant. I gotcha.
Yep.
All right. Well, any details you want to share with any of the deals that you have going on to entice some people that are?
I would say in general, if we do like a value add, just syndications in general, let's just put it that way.
Okay.
If we do value add apartments, we typically don't even offer a deal unless there's a 15 to 20% return on your investment averaged over 5 years. So we look to double your money in 5 years. When it comes to development, it's different metrics because, well, we really shoot for yield on cost, but we can provide super strong returns, but you have to be aware that there's no cash flow in a development. There's no renters. Right now, we're seeing a lot of investors really wanting cash flow, even though cash flow is low. Like for this other property we're doing in Columbus, it's a value add. It exists. It's 97% occupied. We're going to have 3% cash on cash the first year. So if you put in $100,000, you're only going to get $3,000. But for some investors, that's comforting. Mm-hmm. So it's interesting.
That the $100,000 is still there.
Yeah. And that's the thing, is you're investing in a tangible asset that's appreciating, and we're doing forced appreciation with value add. We're essentially flipping apartment buildings like you do a home, but we keep it occupied and we keep it cash flowing. So understand your goals. I mean, if people invest in the stock market, they're in there for long term. Most people aren't trying to live off the dividends to pay their bills. So I would view any of these projects like that until you develop a big enough portfolio to where you have, say, 10, 20 properties that you've invested in over so many years. Now those cash flows are super tangible, and you can now live off of that passive income.
But you can also throw off a dividend if they're investing in the fund as a whole, correct? So that could be dividend investing if they're just investing in the entire fund, not particularly in a development or a project or a deal. Is that right?
No. So funds in our world is more like, it's like investing in a single property from a cash flow and sales standpoint, only you diversify it even more. So one $50,000 investment on the current one I have, you're invested in 3 properties, and they all cash flow at their different rates, and they will all sell at a different time. So you're in 2 different states and 3 different cities. So it's kind of a really cool diversified portfolio, but there's no dividend. It's just cash flow.
Okay. So you mentioned sale. Are you long-term investing in these, or are you flipping them? And when I say flipping, are you holding them for at least a year and then trying to
Yeah.
put them on the market and sell them?
So all of our business plans start at 5 years. That's the basics. We shoot for 5 years, double your money in 5 years. Now, if we happen to find an opportunity to sell in year 3, we will. The goal is to get in and flip it. But to turn a property in a year is fairly rare, but we will hold it for longer than a year for sure.
Okay.
So we're in that capital gains category versus earned income.
Yeah.
If I get that right.
You do. You've got it. And that's the majority of my audience. Everybody's looking for cash flow. But they're looking somewhere to put their liquidity. But the biggest thing is they're wanting to be tax efficient. They're not wanting to be tax avoidant. They're not wanting to do that. They just want to make sure that they're paying the least amount of tax possible with the dollars that are going in and then the dollars that they're getting back. That's all they want.
Yeah. So
go ahead.
Yeah, so I'm not a CPA, financial advisor, but I will tell you what I do know.
Okay.
Is there, yes, the wealthy invest in real estate because there's a lot of tax benefits to it, but you have to be very clear what those benefits are. You're essentially deferring your taxes. When you put $100,000 into a property, especially commercial property, we can get 80% depreciation, accelerated depreciation in the first year. So last year was 100%. To give you the real legit example, in that Augusta project, I believe we got a 90% tax loss. So if you invested $100,000, that your K-1 document showed a $90,000 loss.
Right.
But that only
it's a whole other asset class that people are investing in, that they're investing in real estate losses, accelerating that depreciation. Instead of depreciating it every year, you take the depreciation up front.
Yeah. So we do that with commercial real estate because the tax code allows us to do that. Last year was 100%, this year's 80%, next year's 60. It'll keep going down to 40. And at some point, everyone's talking, they'll change the law again and boost it back up.
Yeah.
But I want to be very clear, though, that tax loss only counts against passive income. It does not count against your W-2 income unless you're a real estate professional. So if you own a huge portfolio of properties, it's great because you have depreciation on all those properties. You're getting passive income from those properties, which is likely counteracted by the losses. You sell one property, you buy another, and you're constantly in this defer game. There's what do they call it? The 4 Ds of not paying taxes: defer, die.
Yep.
But if you have earned income, you're still paying your standard taxes on that earned income.
Yep. Which everybody has some unearned income, but if you're a real estate professional, and it doesn't take that much to be a real estate professional, it's just the amount of time that you are dedicating to the real estate properties that you own.
Yep.
Anything else you want to share? This is really great. We're gonna stop and then we're gonna talk about a deal that I have off camera.
Okay. I guess the only thing I have is if you want to contact me, the easiest way is investwithflint.com. That takes you to my company, investiscapital.com, but people seem to remember Invest with Flint is easier.
I like it.
And then if you're on LinkedIn, I do a ton of content there. So it's just /Flint Jamison. And reach out. Get on my investor list. That's the only way you're going to see deals.
Right. And so that's is that an opt-in? I can put that on the website and then they can opt into that.
Yeah. Through the website, you do have to fill out a form because I'm following all the SEC regulations. So you will have to fill out a form and then you will talk to me because I don't like having investors who never talk to me. I like to at least have some sort of relationship.
There you go. Well, Flint, thank you so much.
Yeah, thank you.
This is exactly what I wanted. Thanks so much.
That's great.
Thanks for listening to The Brandi Jo Show. You can find out more on her website, brandijonewman.com.